Welcome to Intelligent Investor Insights with Joshua Barone, your host and guide through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome to the show, everybody. I'm Josh Barone, and today we need to talk about some very expensive math that is currently colliding headfirst with reality. If you open any tech blog or listen to the latest venture capital pitch, you hear this breathless narrative that we are just a few algorithmic breakthroughs away from artificial general intelligence, AGI. It is treated as this pure, elegant computer science problem. But let me tell you something from 30 years of managing wealth and staring at balance sheets. The laws of thermodynamics have nothing on the laws of corporate finance. The core thesis of the paper, AGI, yeah, right, is incredibly simple yet completely ignored. Technical possibility is entirely secondary to financial permission. The market's response to these fantasy timelines is a collective dry, yeah, right. You see, we've built this collective blind spot where we assume that if a lab can build it, society will fund it. But no laboratory breakthrough can bypass the clearing of the requisite capital commitment. AGI isn't just a software challenge. It's a balance sheet and capital allocation problem. And right now, the balance sheets are starting to scream. To understand why the timeline is breaking down, we have to look at the math. It's not one single hurdle. It's what I call the 4 multiplicative constraints that create a binding ceiling on this entire industry. Let's walk through the numbers step by step. First, we have the direct compute baseline. Davenport and Srinivasan, in their 2025 paper, established that the baseline for frontier training is now firmly north of $100 million per run. And that is just the raw compute. It doesn't include the open-ended retraining operating expenses required to keep these models from drifting or becoming obsolete the minute they're deployed. Second, we have to talk about how we value these future payoffs. Goldstein's 2024 work shows a massive 25% to 35% present value compression of distant terminal outcomes post-2022. Why? Because the market is realizing that a dollar earned 10 years from now in a highly uncertain competitive market is worth drastically less today than we thought during the zero interest rate fever dreams. When you compound that compression with the third constraint, the massive regulatory compliance costs we are seeing roll out, and the fourth constraint, which is the sheer physical resource scarcity of grid power and silicon, you get a multiplicative trap. Each constraint doesn't just add to the cost, they multiply against each other, shrinking the investable universe for these models to almost zero. Let's look at the big players, the hyperscalers, Pichai, Nadella, Jassy, and Zuckerberg. In 2026, the big four are projected to generate a jaw-dropping combined operating cash flow of $380 billion. That sounds like an infinite war chest, right? You'd think they could fund 10 AGIs with that kind of cash. But this is where basic corporate plumbing comes in to ruin the party. A recent Bank of America estimate reveals that once you account for baseline maintenance capex, non-AI infrastructure, share buybacks to prevent dilution, and dividends to keep institutional shareholders from rioting, these companies have a 94% post-payout burn rate. 94%. That leaves a tiny 6% discretionary buffer for speculative R&D. So, if you want to double down on a $100 billion training cluster, you can't just slide it into the existing budget. You have to borrow. But post-2022, debt financing has a real cost. The implicit leverage requirement means that borrowing to fund non-yielding speculative R&D at 5 or 6% interest is a quick way to get your credit rating downgraded and your stock pummeled. Capital markets are holding the ultimate veto. Now, the tech optimists will tell you, don't worry, the revenue is coming. Enterprise copilots and search integration will grow exponentially to offset these costs. To that, I say, look at the actual utility curve. What we are seeing is a monetization plateau. Narrow task performance, like summarizing an email or writing a basic SQL query, is highly valuable, but it quickly saturates a customer's willingness to pay. An enterprise might pay $30 a month for a helpful assistant, but they won't pay $300 a month when the assistant still hallucinates legal citations. So you have linear revenue growth colliding with exponential compute costs. And it gets worse when you factor in Worth's law from 1995. Worth's law states that software bloat outpaces hardware gains. We see this every day. As chips get faster, developers write less efficient code because they can rely on the raw horsepower. In AI, alignment overhead, safety guardrails, massive labor costs for reinforcement learning, and general software bloat are eating up the hardware efficiency gains of NVIDIA's latest architecture. We aren't getting cheaper intelligence, we are just building heavier machinery to move the same pile of dirt. Let's do some quick corporate finance math, the kind my dad, the economics professor, would have made me calculate on a yellow legal pad. Imagine a hypothetical AGI terminal outcome that yields a massive $2 trillion in the future. If you discount that terminal value back to the present day using a low inflation, zero interest rate discount rate of 3%, the present value looks beautiful, over $900 billion. It looks like a no-brainer investment. But slide that discount rate up to a realistic 7%, reflecting today's cost of capital and the sheer technical execution risk, and that present value is slashed to a fraction of its former self. It completely eviscerates the economic justification for the upfront capex. And we are seeing this exact gravity play out in the private markets. According to Global Data Analytics, the 2026 venture capital contraction is brutal. We've seen a 38% drop in median seed and Series A fund sizes. Later stage frontier rounds have cratered to just 12% of available dry powder. Limited partners are demanding a 400 to 600 basis point hurdle rate premium just to look at deep tech. And the added friction of CFIUS national security reviews is acting as a permanent regulatory tax on cross-border capital. The private funding engine is running out of gas. And speaking of taxes, let's look at the regulatory landscape. The EU AI Act, specifically Article 51, sets a systemic risk threshold at 10 to the power of 25 flops. If you train a model that crosses that computational threshold, you are automatically classified as a, quote, systemic risk system. This isn't just a label. It trigger warns a massive avalanche of compliance mandates. We are talking about non-recoverable compliance costs, estimated between $180 million to $420 million annually per model family. This includes independent third-party audits, continuous adversarial testing, cybersecurity standards, and detailed energy consumption reporting across both EU and US executive mandates. This isn't a one-time fee. It is a permanent annual regulatory surcharge. In financial terms, this functions as a massive ongoing cash drain that effectively increases the discount rate on these long horizon bets. You have to run incredibly fast just to stay in the same place regulatory-wise. Some people point to sovereign wealth funds in the Middle East or massive public pension systems and think, well, they have trillions. Surely they will fund this. But that ignores the strict mandate of institutional asset management. These funds operate under rigid asset allocation frameworks, typically capping thematic high-risk tech bets at 2 to 3% of total AUM. They cannot and will not abandon their fiduciary duties to fund a speculative compute cluster in the desert. If you want a reality check on how long deep tech development actually takes when it's done systematically, look at IBM's quantum computing roadmap. Their Starling platform is slated for 2029, and the Blue Jay platform, aiming for 1 billion gates on 2,000 qubits, isn't scheduled until 2033 or later. That is a decade-plus amortization horizon. It requires deep, patient, institutional capital, not the frantic, short-term return profiles of typical venture-backed funds. Ultimately, the lesson here is one of humility. The laboratory can show us what is possible in a vacuum, but the capital markets dictate what actually gets built in the real world. Until the microeconomics of these models can clear the hurdle of a 7% discount rate and a 94% corporate capex trap, AGI remains a fascinating but financially locked horizon. Thanks for listening, and I'll see you next time.
Thanks for joining Joshua on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.